Thanks for sitting down with me today, guys, for our fourth episode of Plan, Protect, Invest, a Scroy Lawley podcast. I know today we're going to talk about businesses and specifically selling a business. We're going to have a number of episodes to come in the future that discuss all the other aspects with businesses, such as different retirement accounts and things that business owners should consider. But today, to keep things a little bit more focused, we wanted to talk specifically about selling a business, everything that goes into that as far as valuation goes, how to structure any sales, as well as going over buy-sell agreements as well. Now, Matt, when it comes to selling a business, a big piece that goes into that is figuring out how much it's worth, what the total net worth of the company is. Can you take us through how the valuation of a business is?
Sure. So when you're valuing a business, there's multiple different routes that you can go down to get to that final number of what the business is actually worth. So kind of depends on what type of business you are, what your end goal is, but for the most part, you're going to do one of three types of valuation: an income-based valuation, a market-based valuation, or an asset-based valuation. Each one of those is going to kind of come at it from a different angle, and they're going to probably present you with a different number at the end of it. So it's really important to know what the ultimate goal of getting your business valued is. So one of the most common types of valuation is what we call 409A valuation. There is an actual purpose for these types of valuations, and if you are a company that is selling stock options to your employees, that's what you're going to use to get the value of what those potential stock options are. However, a lot of people in the industry use it as kind of a baseline as to, this is what my business is worth from a 409A standpoint. For the most part, that value is probably going to be a little bit lower than if you went and did a full enterprise or market valuation. But it's a good rule of thumb, and it lets business owners kind of know where they are and kind of what the floor of their business is worth. If you are going after it after a valuation for the purposes of selling your company or for the purposes of valuing your company to structure buyouts or succession planning, you're not going to want to just do a 409A evaluation. You want to dig a little bit deeper and probably do an income-based or a market-based approach. So a lot of things go into what a company is ultimately worth. The main things are going to be your revenue, your expenses, and the assets that you hold. So each company is going to be a little bit different. Service-based companies are not going to have as many assets, so you're definitely going to go to more of a revenue or an income-based model because pretty much everything they have is going to be the income that comes into the door. Other type of companies like contractors, somebody that needs a lot of heavy equipment to perform the job that they say that they can do, they're going to have more hard assets. So you're going to have equipment, you're going to have warehouses, you're going to have a lot more in terms of actual hard assets that are going to be on your balance sheet. The type of company obviously plays a role in all of this. One of the biggest factors when it comes to valuation is again, what the purpose of the valuation is for. If you are going down the sale route, then you're probably going to go towards a market-based or an income-based valuation because you want to essentially see what the market thinks about your company. And out there, it depends on who's buying you, who's interested in buying you, or if this is just a pure succession play. But the value of your company can vary greatly depending on who is looking to buy you. Private equity has been buying a lot of companies, in many different industries, over the last couple of decades, and their prices are probably going to be a little bit higher than what your son or daughter or whomever is going to pay for your company if you were to hand it down the line. So the totality of the case is definitely going to come into play with the valuation because a valuation of a company that is being handed down to a son or daughter or whomever is definitely going to be a lot different than a valuation of a company that is being approached by private equity or venture capital or something along those lines.
How often should a business owner be evaluating their business, and who should they be working with to get that done?
So frequency evaluation is definitely another facts and circumstances sort of play here. But if you are getting 409A valuations, those down and dirty valuations, Every year is definitely advisable simply because they're relatively quick and easy to put together, relatively inexpensive as well, especially if you are operating a program with stock options and things like that. You want to make sure that you're valuing your company correctly, so you're pricing those options correctly. So you're going to want to get that done on a yearly basis. If you're going into it just to get an enterprise value for the purposes of selling or potentially a buy-sell agreement, which I know we'll be talking about later, those should be done probably at most every 2 years, if not every year, especially if there's a buy-sell agreement attached to it, simply because you want to make sure that you're valuing your company correctly for the buy-sell and the nature of those types of agreements. If you're just going out to figure out, okay, what's my company worth so I know what to be asking for when I, decide to put it on the market, that's probably not as a frequent need to continue updating the valuation. But if you do get any sort of, true interest from an outside person or private equity company or anything like that, definitely should be one of the first things on your list. To get a valuation, typically most people start with their CPA. Not all CPAs are going to be able to do a valuation. There are specific valuation credentials that some people do have that are typically lined up with the CPA, but some attorneys will do valuations, some independent valuation companies will do valuations, but typically the best place to start is going to be your CPA. So Hayden, now that we know how to get your business valued and how that valuation may be conducted, let's imagine we have a valuation for the company and we're looking to go sell. What are some of the big top line tax implications for selling your business?
Yeah, so the first thing we want to think about with tax planning is this is something we want to take care of before the deal. This is a proactive tool that we install to make sure we maximize the most we get out of our business sale. So a fundamental concept in financial planning, whether it's working a regular job or selling a business, it's not about what you make or in the sense of a business, what you're selling it for. It's about what you keep. Now, without proper tax planning, that could eat up anywhere from 30 to 40% of the sales. So we want to make sure we use this tool proactively. So one of the first things we can look at from a high level is how is the deal structured? We have an asset sale versus a stock sale. So just in general terms, with an asset sale, each part is taxed differently, either at ordinary income rates or capital gains rates, and the ordinary income rates take a bigger hit typically. Then with a stock sale, that is all capital gains rates. So there we see some big tax savings.
And if a business owner is thinking about doing an installment sale versus, a lump sum, how can they go about doing that, and what are the implications for them?
Yeah, so with an installment sale, that's typically the main strategy you'll see with tax planning in a business sale. And essentially, what it is you're spreading out the income, but also spreading out the tax, right? So, from a high level perspective, what you're doing is trading off that immediate liquidity in exchange for tax savings. However, there is another thing you do want to consider with an installment sale. While you're saving on taxes, you're also suscepting yourself to the buyer risk. So, you're saving on tax over those years, but during those years, you're relying on the buyer to make those payments. So we do want to consider that, but that will usually result keeping in a lower tax bracket each year, spreading that out versus if we didn't use an installment sale, just took everything up front, recognized all of that gain in 1 year, that could typically put you in the highest tax bracket if it's a larger business. So from a simple example, say someone sells their business for $5 million, recognizing all that 5 million in 1 year will easily put you in the 37% tax bracket, or if it's stock sale, 20% long-term capital gains. But if we spread that out over several years, spread the tax bill out, give us more flexibility and more strategy in terms of our financial planning.
You mentioned it earlier, but when somebody's looking to sell their business, when should this tax planning be taking place?
Yeah, so with business owners, we typically see the biggest savings when people do this years in advance. So like we mentioned, some strategies, structuring the deal, asset sale versus stock sale, or using an installment sale. These, with an installment sale, give you a tax deferral, but we do want to do this proactively. We want to take care of this even years in advance before we think of a deal, so that way the strategies are ready. Because if you already have the deal in place, your tax outcome is virtually already locked in once the paperwork is signed. So we want to make sure we do this before the deal. So, Matt, for our business owners, tell us why, if you have multiple owners, you'd want to have a buy sell in place.
Yeah, the biggest reason why you'd want to have some sort of buy sell agreement in place with yourself as one of the business owners, as well as the rest of your partners, is basically it's going to protect you from having any unwanted partners eventually becoming partners in your business. So let's just kind of look through a quick example. Let's say Hayden and I are in business together. And let's say we are also both married and have spouses. Let's say, just keep the example simple. We have, no children. And let's say, we're doing good in our business, chugging along. We don't have a buy sell agreement in place. And let's say, God forbid, Hayden were to pass away. What would happen basically is, since his, spouse is his heir, she would now be an owner in the business. And if I didn't have a buy sell in place, what's going to happen is now she's going to be a partner. And if I don't have any liquid money to pay her out, to basically buy her share of the business out from her, she's going to be a partner, and she might want to maybe make decisions. She might want to basically have a say in how things are run, which she would be able to as a partner. If we had a buy sell agreement in place that was funded, it would allow me to basically have the liquid money available to pay her out, where now she wouldn't be a partner, and I could continue running the business as it was.
Buy sells are obviously very important, in planning around the potential death of a partner, but are there other circumstances in which a buy sell could really come in handy as well?
Yeah, there are. Really, I call it the 4Ds, really, and death's obviously one of them. The other one would be disability as well, if one of the partners gets disabled. Also, too, I call it disembarkment, which it really just means retirement. Obviously, you can kind of plan a little bit more around that one. Death and disability are going to be more, you can't really plan as much for those. And then the fourth one would be divorce. That's another big one, too, especially if you and your partner started the business, and let's say your partner, started the business while they were married. And let's say they're going through a divorce and they use marital assets to initially fund the business. Basically, the spouse that's divorcing your partner could say, hey, part of the business, that's my assets, and now you could have them in the mix as well. So that's something, too, that a buy-sell agreement can help protect by having that set up properly.
So, Matt, how often do you think we should review a buy sell? And in general, when should you have a buy sell in place?
You really want to have a buy sell in place basically the moment you start the business, ideally. It's to me, I think it's just as important as the actual partnership agreement or corporation formation like that. It's just as important as that agreement as well. So ideally, you'd have it initially when you start the business. Speaking to Matt's point about valuations, when you're reevaluating the business every year or two, every time you're doing that, you also want to reevaluate the buy-sell agreement, because that's going to tie directly into the valuation, and also why it's so important, right, to get that valuation done, because it's going to influence the buy-sell agreement, because that tells you, basically the net worth of your business, which will determine how much you might need to have funded in the buy-sell agreement, how much life insurance you might need as part of the buy-sell agreement to buy out any future partners from that.
Can you speak to the different types of buy-sell agreements that there are out there?
So there's two types of buy-sell agreements that you can have out there. It's a cross-purchase as well as a redemption. With a cross-purchase, let's go back to the example. Let's say Hayden and I are in business together, and we're just two partners in there. Essentially, with a cross-sell, what's going to happen is I'm going to own a life insurance policy on Hayden, and then Hayden would own a life insurance policy on me for essentially our share of the business. Let's just say it's worth $1 million. So I would have $500,000 on Hayden. Hayden would have $500,000 on me. That way, God forbid, if anything were to happen to either of us, it gives the surviving partner enough liquid money to then be able to buy out potentially their spouse or their children or whoever their heirs happen to be when they inherit those shares. And usually, again, it will be funded with life insurance, unless if both partners maybe happen to be independently wealthy and maybe they're in a kind of cash-rich business where they have the liquidity to do that without the need for life insurance. But obviously, if they have that liquidity need, they would need to usually fund that with a life insurance policy. The second type is what's called a redemption plan. That's basically where instead of the individual partners owning life insurance policies on one another, the actual business itself is the owner of the policies. And that's really important, especially if you have multiple partners. Usually you can get away with doing a cross purchase if you have 2 or 3 partners. Anything above that, though, it might become more complicated because essentially each partner would need to have a life insurance policy on all the other ones. So when you have more than 3 partners, sometimes it might make more sense to go the redemption route, where basically the company itself will actually own the life insurance policy on the individual partners. And then the business itself would be able to, again, provide that liquidity need to any heirs of the business.
A buy-sell is going to be tied to the valuation. So if we're talking about valuations that start to have a few extra commas, a few extra zeros, what can be done with the buy-sell to accommodate that?
Yeah, so sometimes in those situations where the valuation is becoming so high, where it's so much money, where it might not be as easy or as cost effective to get a life insurance policy. In that case, we might look more doing kind of an installment type agreement, where maybe the heirs would get a little bit of a lump sum from potentially life insurance. Or again, if the partners can fund it themselves with their existing assets, that too. Then in addition to that, also doing an installment sale kind of on top of it as well, where then basically the heirs or family members would be getting paid out over a number of years, but wouldn't basically be allowed to have any actual say in the business operations and be able to make any sort of management decisions as far as running the business. They would basically just be getting their payments and not have that level of control that the other partners in the business would have.
So, Matt, what are some of the parties involved with setting up a buy-sell agreement and getting it in place?
Yeah, so basically, who's going to fund or set up the initial draft of the actual agreement? It's typically going to be like a business attorney. Usually, it's going to be the same attorney that maybe even drafts like your partnership agreement, because they're going to be the ones that actually have all that legal language in that buy-sell document. It basically describes how all of that is going to work, how it's going to be funded, how the payments are going to work. And then the second party involved is really going to be the CPA or the accounting firm that does the valuation. Because again, the valuation ties directly into the buy-sell agreement. And then the third party involved would be if there is going to be any sort of life insurance or disability insurance policy, would be an insurance professional that would be able to handle that. So, that's where we can kind of step in as insurance professionals to sell life insurance or disability insurance for those business owners that need that.
Thank you, everyone, for tuning in to our April episode of Plan, Protect, Invest, a Scroy Lolly podcast. Today, we talked about a few things focused on selling a business. Matt, you talked about business valuation. You talked about buy-sell agreements, and I talked about tax planning. Any questions? Feel free to reach out at 716-674-6700 and tune in for future episodes.